Right. Welcome everyone again. Another lovely Saturday. Had some great times here over the last couple of weeks. I think the oil market volatile as usual, but I think it's been we've seen the next kind of run up here as we kind of been expecting, similar to what we saw earlier in the year, kind of the December run onwards into January. I believe Crescent Point is the company I keep mentioning. I think it was up 25 or 30 days in a row, just something crazy. And we're seeing kind of a similar run up here. We've had a couple of red days with the overall market just getting absolutely trashed. So a little bit expected, but energy still held up really well. I just ran the year-to-date comparisons the other day, yesterday actually, in fact, on the oil and gas energy ETFs versus the tech ETFs, and I think the alpha is 85%. So I believe energy was up 61% year to date, and tech is down 24%. So I think earlier in the year we had some concerns that the overall market would bring down the energy complex with it as well. So far hasn't really panned out that way. And as we all know, some of these companies are trading at still WTI prices that are well below where we sit today. And just quietly, WTI has gone from that 95 to 105 range to now this 110 to 115, 122 range. And it's just kind of happened, and no one is really talking about it too much, and we haven't really seen too many impacts quite yet. There's obviously demand destruction and whatnot happening behind the scenes, but all that really matters is the supply demand outlook. So decided to switch it up here a little bit today. Took a couple weeks off, traveled around, and I was talking to a couple people, and this idea actually came from Bill. A lot of people on Twitter know Bill Wabafo. He was talking about NAVs and net asset values and how they're becoming more important, and it kind of gave me a thought to two things that kind of came up. The first one is that more and more people in the retail space are looking at these net asset values in commodity companies. They want to know what's exactly under the ground, what it's worth, how much money are they making off this, the operating costs, the further capital costs required, etc. And a lot of people just don't look at cash flows. They either look at earnings or they look at net asset values. So as we kind of go into that, I thought it was time to kind of update my models to not only look at free cash flow, but now look at the net asset values. And the second thought that kind of came up was that in 2010 to 14, a lot of the multiples we saw were based off the net asset values. And whether it's you want to use PDP, whether you want to use 1P, 2P, whatever, there were some sort of multiple or discount off these net asset values. And I know for a fact, I'm seeing more and more of them pop into corporate presentations. I'm seeing more discussion around them, and a lot of funds, a lot of banks are going to be focusing on these because they like owning the net asset value when they don't trust the cash flow. I think us in the Canadian oil space, we have a different view on the macro than a lot of companies themselves, and a lot of banks, a lot of funds. So if they're not trusting cash flow and we can't agree on the free cash flow projections going forward, we can at least agree on the net asset values to some extent, because net asset values are still highly dependent on your oil price forecasting. But at least there's a common ground there. You have two things you can compare and kind of go from there. So yeah, we'll be doing MEG Energy, Surge Energy. The reason I picked them, kind of two heavy, not heavy, but more so oil focused plays. One is in the oil sands, which treats net asset values a little bit differently, especially because of the decommissioning liabilities and how they're factored in. And then you have kind of your conventional heavy medium oil play in Surge. Full disclosure, they are my two biggest positions, so it just so happened to be this way. But as I do more of these net asset value calculations, I want to bring up gas companies and condensates and NGLs and all that. But as you can kind of imagine, this is not something that is very easy to make. So still a work in progress. So please bear with me. For those who were with me since September, I did about 5 test runs of the free cash flow calculation spreadsheet before it became where it is now in its current iteration. So this net asset value spreadsheet might take 2 or 3 or 4 iterations. It's very, very, very early stage yet. A lot of things are not factored in yet. A lot of things are maybe a little inaccurate, if you will, but it gets the job done. It proves the point, and it gives us that relative valuation again that kind of we're looking for across companies. Yes, a couple things before I get started. I'm not an investment advisor, so please, everything here is my opinion. It's my personal information and data that I use to make investment decisions. Please have a look at your risk tolerance. Please do your own due diligence. Please look at your portfolio construction. They may all be different than the way I'm running things here. This video is recorded. It will be posted on the whitetundra.ca website, just like every other video that are on the website. Under archive seminars, you can watch the previous videos. We've covered 30 or 40 companies using the free cash flow model. The macro outlook, actually, I've been very happy and thankful for people who've been watching that more and more. I'm seeing actually a lot of hits on that, even compared to the newer videos. So I think there's definitely interest building in the sector, a lot slower than I think people expected. The generalist has taken a very long time to come back, but definitely seeing trends kind of going towards that. And as you know, I'm big on data, so I'll try and share whatever I can kind of gauge from that. Yeah, I think that's about it. So we'll get started. The Twitter space also is recorded. And for anyone, again, on the Twitter that wants to join the visuals, whitetundra.ca, scroll to the bottom under events. There is the Zoom link. This spreadsheet so far, I haven't posted it. I'm going to wait until a little bit further down the road. I get a little bit better handle on it. Right now, it's basically hard-coded to the company. So for MEG Energy and Surge, I basically hard-coded it with the certain numbers that are in there. But as we go along, I want to make it more of a plug-and-play spreadsheet, just like the free cash flow model is. So you can just put in numbers and it'll calculate, for example, how many years of tax-free income you have, what the royalty rate changes to. And as you put in different values for WTI, it'll change the royalty rates and the taxation and the revenue and such on its own. A lot harder to do than I thought. I only had about 2 or 3 days to build this, and I wanted to put something out and then get ideas and other suggestions and kind of go from there, as opposed to just spending weeks on something and then it ends up not being very good or very user-friendly. So yeah, so we'll get started. Couple of definitions I'm going to start with that come up very often in the reserves kind of discussions. So we have PDP. Reserves is basically, reserves to begin with is the barrels of oil under the ground that the regulators or the forecasting companies are giving you credit for. So a lot of times reserves is confused with like total land holdings or total oil that a company has. And that's not really true, because if a company has land sitting around and they haven't drilled any wells in the area, they don't have any competitor or offsetting wells, they may not be getting any value for that reserve. And actually with MEG Energy, if we go down here, we see they actually tell you mineral leases without attributed reserves. They have 235,000 acres with no reserves associated because they haven't developed them. And even though you can kind of triangulate and figure out that there's oil there, if there's no wells there that are producing oil, you don't get credit for it. That's just the way the system works. But the point I'm trying to make is that reserves valuations and the NAV values are always going to be conservative, because they don't take into account the full land holdings and the full acreage of that particular producer. So just want to put that out there. So go a little bit more specific. We have PDP reserves, which are your proved developed producing reserves. So these are reserves that are actively currently producing oil. So when you look at a company's production, they're producing X amount of barrels per day. These are the reserves associated with those wells and anything in the area that they've booked, they've got credit for. We also have PDNP, which is proved developed non-producing. So this would be wells that are developed, they're proved, but they're for whatever reason, they're just not producing right now. As you see, it's a very small number. So this is usually wells that are maybe currently being drilled, wells that are shut in for whatever reason for a longer period of time. Usually this is a metric that I just ignore because it's so small that we just can't waste time doing too many calculations on it. It's only 2.5, 3% of our PDP value. So I usually just leave it. Then we have the PUD, which is your proved undeveloped reserves. So these are reserves which are close to or offsetting existing production. So they're proved, but they're undeveloped. So right now there's no oil flowing from these reserves. They're not actively being produced. You add up these three and you get your 1P reserve, which is your total proved reserve. A lot of people like to use 1P multiples. A lot of people like to use 2P multiples. I'm going to leave it up to you. It's all subjective depending on how far down the risk curve you kind of want to go into the forecasting and projections. But the 1P is basically any reserves that's actually proved. And the way the regulators and the companies define that is there's a greater than 90% chance that we have more oil than what it tells you here. So when MEG Energy tells you that net of royalties, these numbers are net of royalties, and these are available on the annual information form. So again, I forgot to say this at the start, but I do have a mailing list. I send out all these relevant files that I'm going to be using a day or two before. So if you want to get on the mailing list, please shoot me a DM or an email and I can get you on there. But basically, every year, companies have to report their reserves. So they give you the gross reserves and then the net after royalties. And basically, that's exactly what I put in here. And yeah, so what MEG's telling you is that 1P reserve, proved reserves, they have 970 million barrels under the ground that are proved. The next thing we have is our probable reserves. So probable reserves, the way they're defined is that they're saying there's an equally likely chance that the amount of oil in the ground is either less than this or more than this. So it's kind of a funky definition. The way you can simplify it is just there's a 50% chance that we have at least this much reserve. Not quite the most accurate way, not the right description, but it makes things simple to understand. Proved reserves, greater than 90% chance that we have more than that. Probable reserves, greater than 50% chance that we have greater than that much in the ground. You add them up and you get your 2P reserves, your proved plus probable, 1.5 billion barrels in the ground. So the other thing that these companies give you, based on whoever they use, whether they use GLJ or Sproul or whoever else for their commodity price projections, they give you NPVs, so net present values. These are undiscounted values for each of these reserve categories. These are discounted at 5%, 10, 15, 20, etc. A question here. Since energy companies pay for their own asset evaluation, how much distortion? So you're right that energy companies are paying for their own net asset value calculations. There's a conflict of interest. There's a bias in a way towards showing more reserve. However, I don't think there's any funny business going on either where people are blatantly lying about their reserves. Something to watch for with mining companies, I would say more so, because you can selectively pick certain drills and certain cores and extrapolate that, without really maybe having that sort of grade across your acreage. And again, I don't invest in mining companies, so I'm just speculating here. But with oil companies, from my time working in them, from my discussion with reservoir engineers and evaluators, is that it's a pretty diligent, strict process. It's not just wishy-washy numbers being thrown around, and it's not just a one-time thing. These companies have been following the E&Ps over 5, 10, 15, 20 years. So they have a good idea of adjusting their model as they go about as well. But anyway, back to this. So we have reserves, we have our volumes, and then we have our NPVs. I'm not going to get into the discussion of how NPVs work. It's just a little bit more complicated subject, but please feel free to look that up. Google has amazing data and reading material on that. So we have this. We also have our after-tax NPVs. So MEG Energy is nice. They give us the pre-tax, they give us the after-tax, and you can kind of gauge what their taxation structure is when they think they're going to start paying tax. It's not really that obvious. There's a lot of work you have to do because like this is literally all they give you. They give you the volumes, they give you the reserves at different discount rates, pre-tax, after-tax. They give you one example of how they got to these numbers, only the undiscounted one. So basically you have to make your own model for the discounted versions and try and match up to what they tell you. And then they give you some other, you know, the forecast. Here are the forecast prices used with GLJ. And all this is available on the annual information form. Every company will have this. So you can check it out. Okay, there's another question here. So the tax is including royalties. Yes, so basically when we get to the NAV right here, the net asset values, the same ones that they give us, it's after royalties, operating costs, development costs, our decommissioning liabilities, and income taxes. So it's basically takes all of that into account, gives you the value of the company, then you subtract debt from it, just like we do with free cash flow calculations. Subtract debt, divide by the number of shares, you get the fair share price. It's a very similar calculation, just the way that we end up there is a lot different. So anyway, I'll get started here. One other thing I want to mention, something that gets brought up a lot in Twitter and BNN and whatnot, is our reserve life index, so our RLI. And basically what that's telling you is if you take our PDP or 1P or 2P reserve and you divide that by the current production, how many years of reserve do we have left? So with MEG, they have eight years of PDP, 37 of 1P, and 59 of 2P. And these numbers will change as the production increases or decreases, and as they get more reserves and more bookings. So just something to watch for. MEG has probably one of the highest 1P reserve, if not the highest that I've seen, at least in the Canadian oil space, maybe even across North America. And also one of the reasons I really wanted to talk about MEG, given that it has this long reserve life that they're not really getting credit for so far, I think. So yeah, we'll get started. The way I've built the model right now, again, it's all hard-coded, but I will have the spreadsheet version of it built. Right now, I have PDP at the forecasted pricing that they give us, and then I've adjusted those to the strip pricing roughly to kind of give us an updated version, because the biggest problem I found is net asset values are calculated based on the forecasted oil pricing, which is extremely conservative. If we look at the forecasted pricing that MEG is using for WTI, they're using $73 for this year. They're using $69 for next year, $67 for 2024. I think some of us would say that none of these numbers are of any use to us. Like, it doesn't really make sense to be calculating net asset values at these sorts of numbers, given kind of where the macro is, given where current prices is. It would be almost impossible for oil prices in 2022 to average the $73 that they had forecasted. We would need to be at $40 or $30 for the rest of the year, which, again, I'm not going to say it's not going to happen, but you go with expected values of how things are going to go. So now that we have the basic definitions out of the way, basically the way I've set up this spreadsheet, I've put the year in, I've put the GLJ, WTI. It's not WTI price. For MEG Energy, I've used the heavy crude oil price and the WCS price and blended it together in Canadian dollars. again, we're calculating everything in Canadian dollars, so we need to use the Canadian dollar forecast. MEG Energy sells their Access Western Blend, which gets, if I'm correct, $2 or $3 below WCS. So I've basically taken a blended average of WCS and the heavy crude oil and made up, or not made up, and calculated a number here for the average forecasted price. This is our years. So basically every year onward, year 1, year 2, year 3, that's important for the discounting rates. If we're using 5%, 10%, etc., we need to know what year we're in to begin with. This column here is basically giving us the production for the year. So if we go back to MEG Energy's MEG Energy's annual information form, they say this is the production that they've calculated their reserve life index and their reserves at. So it's not really the current production, but because that's what they give us, that's what I'm going to use. So I go back here, I've taken the 93,733, multiplied by the number of days in the year and divide by million. So basically they're producing 34 million barrels every year kind of going forward. And once again, once this spreadsheet is going to be more user friendly, once the yellow boxes are back in, which allow for that flexibility, I will put in ways that you can manually adjust this or put in some sort of growth rate. You know, you want to put in a 2, 3, 5% growth rate in there and have the spreadsheet adjust accordingly. So far it's not there yet. Okay, so we got a question here. I've noticed before that most companies use the same forecast prices. Yep. So almost all the companies are using the same forecast prices, either from GLJ or Sproul or one of the other forecasting companies. It just makes things easier. It consolidates the relative comparisons across the industry, and the reserves only get updated once a year. The forecasted prices are updated, I believe, either every month or every quarter, depending on the company. But the E&Ps themselves don't adjust their reserves to account for that. They just leave them what it is at year end, and then the next update will come in kind of with the Q4 2022 results around February or March, next February or March. And it's just a long time to wait. If we don't have these sorts of Excel models to adjust for the pricing, we're using $73 oil or $70 oil. And as much as I can go and I can pull reserves for all 55 or 60 companies that I track. I can pull the reserves for year-end 2021 at $73. It doesn't really mean anything to me unless I can accurately adjust them to a $100 oil price environment or 110 or 95, whatever number you want. And as we know with free cash flow calculations, certain companies have higher torque to the higher pricing. And for us to just compare everything at $70 oil, you know, maybe it works for certain people, but when you adjust it to a different WTI commodity price environment, there's certain opportunities that start to look more attractive as prices go higher, or if you have a different view on the commodity price environment going forward. So yeah, thanks for that question. This column, basically all I've done, D2 times B2. So I've taken the volumes that are expected to be produced for the year and multiply it by the price. So you get your revenue. The next thing we've done is the royalty. So MEG Energy is kind of in a weird situation because they're in pre-payout royalty right now. They will go into post-payout royalty. Let me see here if I can find where they said that. Yeah, so basically, they even tell you all this. They tell you the Christina Lake project is subject to pre-payout royalty rates, which are in the 10 to 15% range, the way the royalties work right now. And the corporation anticipates that the payout will be in the second half of 2023. Now, prices have gone up a lot and I don't think it's going to be second half of 2023 anymore. It's likely going to be Q1, maybe mid or early Q1 of 2023. So again, I just want to explain what I've done here. So we go back up here. What MEG Energy is telling us is that undiscounted, the royalties they expect to pay is roughly 20%. If you take 3870 and you divide it by 19,793, again, we're looking at just PDP reserves here. So just PDP, we'll get into 1P and 2P here as we go on. But again, I don't know which metric you want to use. I don't know which metric the banks are going to use. It's all subjective. So the spreadsheet is built to have PDP, 1P, and 2P. And basically the multiples can be run off either one, depending on the way the market's going and the way that banks are talking about it, the communication we see on these conference calls, etc. So again, the royalty is roughly 20%. That's over the entire PDP cycle. Remember, the PDP cycle is 8 years. So it should average out to roughly 20% over the 8 years. We need to adjust for this. Why? Because when we leave everything undiscounted, it doesn't really matter when the royalty is paid, at what percentage it's paid, as long as it adds up. But when we start discounting at 5 and 10%, if we're paying 10% royalty for the first year and then 25 onwards, or we're paying 20% royalty for all 8 years, the discounting on that makes it a lot different where we end up. And again, I know I'm getting into the weeds here, but it's very important to adjust for the near-term cash flows, because the discounting makes a massive difference on where we end up. And it makes a massive difference on what the banks are seeing, what the funds are seeing, what people who are calculating NAVs are seeing. There was a big discussion as to why MEG Energy was lagging. TD came out with a report on this post-payout royalty thing. And after that, the stock just stood there, didn't really do anything. And if I was a betting man, I would bet that a lot of people went back and said, look, we need to adjust our model here for the higher royalty after 2022 or after 2023. And once they did that, once the discounting on that came into the calculation, it adjusted things pretty significantly. But I digress. So what I've done here, I've put a 13% royalty for the first year, which is 2022, up that to 15% for next year. Given that I don't know what the plan is, are they going to spend more capital and get more royalty credits? Possibly 15%. And then I go back to the 21% roughly that MEG Energy tells me. If I go back, again, 3870 divide by this, roughly 20%. So if I'm paying 13% year one, I'm paying 15% year two. Now I got to pay 21% in the rest of the years, so that my overall adds up to 20%. Lots of deep math, lots of guesswork, lots of fixing the model to kind of figure out, make it match the numbers, because I mean, this is literally all they give us. They don't give us the deep calculation on how they got to each of these numbers. I'm sure there's a way to get it. Maybe not for the companies themselves, given they're public companies. I don't know. I haven't looked into it, but I will be looking into it if there's a way to get more deeper insight into how they came up with these numbers. For now, I'm just going to guess, and the model has actually ended up being very accurate so far. So yeah, so we have our pre-royalty revenue, we have our after royalty revenue. This year, again, if we go back to our reserve life index, it's 8.2 years. So our 9th year, we want to multiply it by 0.2, which is 66 days of the year is roughly 0.2 of the year. And we have our 8 full years and our 0.2 of the year. So we have our post-royalty net asset value. Now we need to subtract costs. So how do we calculate the cost? They give it to us. They give us the operating cost, the development cost, and the abandonment and reclamation cost. I want to emphasize, nothing here is 100% accurate yet. I'm going to be working on getting it more precise, more accurate, more fitting to the model. But right now it's just a broad-based, we want to be 90% accurate, but we want to adjust the price from 73 WTI to 95 or 100 or 100 plus WTI. So what I've done, I've basically taken these three numbers, added them up, it becomes 5676, and I've divided it by 8.2, the number of years, and I've basically just put a flat $692 million cost for operating cost, decommissioning, and what is it, and our development cost for the next 8 years. Remember that oil sands projects are capital intensive upfront. MEG Energy has spent most of the money required for their PDP reserve upfront. It's already been spent. That is why the development cost is so low compared to the undeveloped reserve. If we look at it, the development cost for the PDP is roughly 5%. The development cost on the undeveloped becomes almost 15, 20%. Again, lots of adjustments we need to make, lots of things we need to take into account. The percentages change as we go from PDP to undeveloped to 2P. Yeah, there's a comment here and a link explaining the pre-payout versus post-payout royalties. So please check out this link for more information as to what I'm talking about. A very data-driven, very highly adjusted spreadsheet. There's a lot of adjustments we need to make, whether it's for royalties, tax, escalating costs, etc. And I hope to simplify it, just like I did the free cash flow yield spreadsheets as we kind of go along. But again, I just want to share these two companies and kind of where we ended up in this iteration. So yeah, basically we have the gross revenue, the net revenue after royalty. We subtract the cost, we end up with the after tax or the pre-tax revenue. And then MEG Energy tells us they have roughly $6 billion in tax pool. So I just add them up until they reach $6 billion roughly. And then I start taxing them at the 25%. So, you know, we add these up, we end up at roughly $6.5 billion. And that's when I start taxing them. As the years go on, as their tax pools get lower and lower, we would start putting this taxation earlier and earlier in it. So again, it's a very intuitive, very deep calculation. There's a lot of adjustments. I know I keep saying this. This is not as simple as the free cash flow calculations because each company has different royalty schemes. They have different royalty rates. The royalty changes as the WTI changes. The taxation rate changes. The cost change. The development cost is different for oil sands versus conventional. So yeah, something that it really affects the end values, how we come up with these numbers. And we always want to compare them back to what the company ended up with. We don't want to be way off on a higher number or way off on a lower number. But if we have one data point to compare to, then we can adjust for the different WTIs, the different royalties, etc. Just that a little bit easier. So we have our after-tax cash flows after royalties, after operating cost, after development, after decommissioning, and after taxes. These are the cash flows we end up with undiscounted. And what the spreadsheet does at the end, it adds them all up. That's your total value of the company for PDP on the forecasted values. You minus your net debt and you divide that by the number of shares outstanding, and you get a fair share price of roughly $26 per share of MEG Energy. So there's a couple of questions here. So what do you do to adjust for the ARO? I haven't done anything. I'm just using for now the abandonment and reclamation cost that they're giving me, and just putting it over the entire 8 years. When we go to the surge energy example, I will show you how I've actually adjusted that to have it occur later, because when the wells are proved, developed, producing, none of the ARO is going to be right away because the wells are still producing. So we have to put them later in the future. And I'll talk about that in the surge example. There's also a question here, is this an asset level NAV? Do you adjust for corporate G&A and interest? I don't know. I don't think it's that important. Corporate G&A in most cases is $1 or $2 a barrel. Interest in most cases is $1 or $2 or $3 a barrel. We can adjust that by not putting those in, but just by adjusting the prices. So if you want to put those in, all you would do is go back to your prices and just subtract $3, let's say. Subtract $3 for G&A and interest, and you can put that in there. And that's a great suggestion, because that's exactly how I'm going to build a spreadsheet that's going to be put out there for use. So appreciate the comment. So yeah, Dirk has some information here again from the page about the royalties. So please read that if you want to look at royalties more in detail. Yeah, so just hang on to the market price evaluations, because I'll talk about why that's not the correct price. So the fair share price on PDP using these values for WTI for the oil that MEG sells in Canadian dollars. We can't be using these numbers if we want to be looking at the current NAV. So in this sheet here, they're going to be adjusted to the current strip pricing. But before I get there, the exact same model that I just did, all we do is we discounted everything at 5%. We discount the revenue, we discount the royalties are already discounted because we discounted the revenue. We discount the cost at 5%, which again is not really accurate, because when we discount cost 5%, we actually need to increase cost as well by 2 or 3% to account for inflation. For now, I've left it out. As the model gets better and better, inflation and escalating cost will be put back in. For now, it's not. But basically, if you want to put inflation back in, you just, instead of adding 5%, you add the 5%, then you take out 2% to account for the inflation. Very early model of the spreadsheet, it's not in there yet. And we end up with the same thing. We end up with after-tax cash flows at 5%. Because these cash flows are a little bit lower, the taxation doesn't start until 1 or 2 years later. You know, pretty simple. You just add them up until we get to the whatever tax pool they tell us they have, and then you start taxing them. Same with the 10% discounting. I don't do 15 or 20% discounting because I think it's just completely fake. There's no point going to those sorts of discounts. As far as before I get there, these are the fair share prices, undiscounted, 5% discounting, and 10% discounting. What number should we be using? Almost every bank, almost every hedge fund, almost every retail, even investor will use 10%. It's just so embedded in finance and people who worked in finance that people just use 10% discount for everything. Subjective. I use somewhere between a 5 to 10% discount rate. I don't use 10. I use maybe 7, 7.5, 8, depending on the company. And why is that? Because the oil fields are not unlimited, where you just have some company that can grow or that can produce forever. Oil sands, the oil field, there's only so many assets, there's only so many reserves, there's only so much oil out there. The demand also continues increasing. It's not a dying industry, despite what people will tell you. The reserves are only so much. You can't just create reserves out of thin air. You can't just create oil in the ground out of thin air. So I don't think the 10% discount rate accurately figures out the actual value of these oil reserves going forward. 10, 15 years from now, if you use a 10% discount rate, you're saying that that reserve 15 years from now is basically worthless because you're dividing the 10%, or you're taking 10% to the power of 15 and discounting that barrel that much. I would bet that 15 years from now, that barrel is worth way more than what we're giving it credit for if we use a 10% discount rate. So I'm going to keep it simple. I don't have any background in working in finance, so I'm not going to try and justify this using any sort of deep justification. It's just that the 10%, I think, just does not give credit fairly to that barrel going forward, especially in a time of declining supply, rising demand. It's getting harder and harder to find this oil, that I think that reserve for 10, 15, 20, 30 years should be given way more credit than it is. I wouldn't be using undiscounted rates either. So, between 5 to 8%, I believe is a good range. If you want to use 10%, feel free to use 10%. Okay, so there's a question here. When will MEG hit payout on its SAGD projects? So the payout will be, in my opinion, by my calculation, around Q1, early Q1 2023. And you might have missed the earlier part of this presentation, but the royalties have been adjusted from 13% to 15% to then 21% going forward. In the last conference call, Derek Evans said that they project royalties between 20 to 25% after they hit post payout. So they're not banking on that 40%. They're looking at 20 to 25. That's what I'm going to use. Again, once the spreadsheet is more built, that will be a subjective yellow box. You can put in, okay, I expect them to pay 27% royalty or 32% royalty, whatever you feel going forward. Yeah, there's lots of comments here on that, so please check out the chat for more. But yeah, that's the spreadsheet. So we end up here. Now what I'm going to do is adjust it for strip pricing. So what I've done is put 110 WTI for 2022. I've put 100 WTI for the next 4 years. I put 90 for the next 4 years after that. And then I've gone back to the forecasted numbers that GLJ gave MEG and that MEG used for their reserves reports. Not very accurate, but I'm not going to be the first one to try and forecast oil price in 2031. It's just a fool's errand. So I'm just going to leave it as is. Okay, there's a question here. How do tax pools affect royalties? They don't, no. So Robert, thank you. Yep. The tax pools are separate from royalties. It's a triple taxation system. The government collects royalties, then they collect taxes, and they also collect taxes on the people that work there and all the income tax off that. So yeah, no further comment on that. But basically, when we take this strip pricing for what the strip is kind of telling us, it's not entirely accurate. It's my projection on where I see this cycle going, my crystal ball, what it's telling me. 2 or 3 years out, not accurate, but whatever you feel, it's very flexible. And we end up with fair share prices, undiscounted $41, 5% is $34, and a 10% discounting about $28. Again, I would pick a number between 33 and 28 because I'm picking between 5 to 10% discounting, roughly $30 a share, debt adjusted after royalties, after taxes, after everything. So now you might be thinking, well, it doesn't seem like very much upside from here. And that's because we're only looking at PDP reserve. So don't forget, MEG's PDP reserve is only 8.2 years. Their 1P reserve is 37 years, and their 2P reserve is 59 years. So whatever they have other than their PDP is already proved. They already know there's oil there. It's just not producing. So what I'm going to do, the exact same calculation on 1P reserve. So instead of 8.2 years, we're now going to go all the way to 37 years. So the exact same spreadsheet, the exact same production. Basically, the only thing that's adjusted are the cost. And the reason the costs are adjusted is because when we look at the undeveloped reserves, the PUDs, the development cost is much higher, the operating cost is much higher, and the royalty percentage is much higher. It's gone from about 20% to about 25, 26%. So when I run my royalty calculations here, where am I? Sorry. When I run my royalty calculations here, now I'm using a 23.5% royalty going forward. You can use a 27%, you can use 30%. That's the way the spreadsheet is going to be built once it's set to be out there. But again, more adjustments, the better. The more we can adjust for these things, the tax, the development cost, the ARO, the better model we will end up with. So exact same thing, exact same spreadsheet. We're now using the forecasted prices. We're back to forecasted prices, but on 1P reserves. And whoops, we end up with fair share prices that now actually start to get people excited. Undiscounted, $126 a share, 5% discounting, $57, and 10% discounting, $32. Again, if it was my model that I'm using, I would pick a number between these two. So end up at roughly $45 a share. Again, that's at forecasted prices. If we adjust those to strip pricing, what we end up with is undiscounted $146 a share, at 5% $75 a share, and at 10% $47 a share. Once again, if it was me, I would pick a number right smack dab between these two. So 75 and 47, the fair share price ends up being $62 a share, about a 3x from where we are today. I think shareholders will be pretty happy to hear that. Now, for anyone that wants to use 2P reserve, again, 2P is not 90% guaranteed. We're down to the 50% range. And for anyone that joined late and you're kind of lost in the 2P, 1P, NAV, and all this, I did talk about these at the beginning and explained the definitions and what they mean. So we do the same exact example for 2P reserves. We end up with these share prices. When we do the 2P strip the 2P reserves at strip pricing, again, undiscounted, $229 a share. 5% discounting, $84 a share, and we have our 10% discounting at about $48 a share. So pick the midpoint again, we end up at roughly $65-ish a share. The other thing now I'm going to do is I'm going to go back and compare my numbers to what they tell me. So PDP at forecasted pricing is what they tell us. So right here, after tax PDP at 0% was 9,334. Our model ends up at 9,312. At 5% discounting, 7,773. We're at 7,847. And at 10% discounting, 6,610. We end up at 6,541. So doing these checks against what MEG Energy tells us, against what GLJ tells us, verifies the model that we're working closer and closer. And the model should not get deviated across these PDPs and PDP strip and 1P and 2P, because if the model deviates, that tells you that you've modeled it too much to one certain number, as opposed to being something that's actually accurate across a range of reserves and prices. So when we do the same thing at 1P reserve, basically it's 37,296. We're getting a bit off now. We're about 5-6% off. And we have 18,520 and 11,449. So pretty close here, but again, not as accurate as the PDP was. So we have, okay, let me just get through these questions. So on these projections, do you account for the spread on WTI to WCS? Yeah. So the number I'm using here is actually not WTI. This is a mistake that I put in here. It's the heavy oil and I've made my own pricing basically from the heavy oil forecast and from the WCS forecast to account for the Access Western Blend that MEG sells. It's already in Canadian dollars, and because it's WCS, it already accounts for the spread. Could it be more accurate? Certainly, but for now, it doesn't really matter. Just like the free cash flow spreadsheet, we're not trying to be 99.99% accurate. We're trying to be 90 to 95% accurate in the most efficient use of time. If we have to look at 50, 60, 100, 500 companies, we cannot be bothered by that last 5% of accuracy that just takes forever to figure out and get bang on. That's just the way these models are set up. If you're an equity analyst or you've worked in finance, you may not like that way of doing things. But the reality is we need to get through companies and find the good ones. We can't be wasting time on companies that don't have free cash flow, that don't have net asset value, trying to get that last percentage of accuracy, because it doesn't matter. If they don't have the net asset value, why bother looking into it as an investment, right? So just a couple thoughts there. Are these calculations taking share buybacks into account? No, the share buybacks are not being taken into account, but basically all we would have to do is adjust right here the number of shares outstanding as they keep buying back shares. Once again, I keep repeating the same thing. This spreadsheet was hard-coded because I just wanted to put it out there and get suggestions as to kind of how to build it, and I haven't really had the time to get it fully built yet. But maybe I'll put a thing in there for share buybacks, and if you buy back this many shares, the model kind of adjusts accordingly. And in fact, Google Sheets is amazing because I can link right to their Google Finance platform and have the real-time share count pop in there. So yeah, thanks for bringing that up. I think you might need to deduct development capex required for 1P and 2P. Yeah, so that's already being deducted in the cost. So this cost column right here includes our operating cost, development cost, and abandonment and reclamation cost. Now, the way I've set it up, is it correct? No, not at all, because this is not how an oil sands project is developed. Most of the capital will be in 1 or 2 of the years, and then it just kind of flattens out or reduces as time goes on. Once the mines and the processing equipment and the wells and everything are built, the cost is basically done. But yeah, thanks for bringing that up for sure. Great point. Nuttall's price target at 100 WTI is $42. You think he's using 2P? I think he's more of a cash flow guy, to be honest with you. But people are using 2P. I get lots of emails and lots of phone calls recently talking about net asset value and why my model doesn't include anything with net asset value. So definitely something I'm going to be focusing on more, because the free cash flow calculations now it's pretty much done after every quarter. The net asset values are only really done once a year, so I can get them done and then basically just have them update real time with the strip pricing and leave it in there. So yeah, still working on that. Yeah, thank you. So that's that. Now, one thing I want to say, you want to look at different models. How can the model be adjusted? So the way I looked at it is, what if somebody buys MEG in the next 3 or 4 years, or even in the next 6 months, and says, look, we're going to jam a bunch of money and we want to double production by 2032. This model can easily be adjusted for that. So all I've done, I doubled production 11 years down the road. And because the reserve was for 37 years, we now need to adjust it down. So our PDP was 8 years, which is already factored in. We have 29 years of proved undeveloped, but if we double production, there's only 14 years of it. So instead of our 1P strip here, instead of having 29 years at 34 million barrels a year of production, we have 14 years of 68 million barrels of production. And basically, we run the same model, and we end up with different fair share prices. And if we go to 1P strip, we had 145, 74, and 46. Under the growth model, our undiscounted fair share price actually goes down. But because we're bringing up production from 20, 30, 40 years down the road, because we're bringing it up, the 10% discount fair share price actually goes up from $47 to $50. And if we want to adjust this further, we think when production comes online, our oil price is going to be $125 a barrel. The spreadsheet will adjust accordingly. That part has already been automated. And we see how the fair share prices change significantly if the macro outlook takes us not into a $70 oil environment in 2030, but into a $125, $140, $150 oil environment. Which, if you know kind of my view on supply demand and how hard oil is getting to find the supply issues, we don't know. Oil could be $80. It could be $150, $200 range. That could be where we end up. And I want to leave the spreadsheet flexible and adjustable so you can put in your own thoughts and numbers and data in there, and the fair share price adjust accordingly. Before I get to the questions here, I'll just talk about the 2P strip hypergrowth. So I adjusted the 1P strip to account for the growth. I also thought, hey, what if we took the 2P strip and we adjusted for a tripling of production? So Christina Lake gets doubled, and then Surmont gets FID'd. We have 200,000 production from Christina Lake and 100,000 barrels a day from Surmont. Where do we end up? Well, we look at our 2P strip hypergrowth. Now we're tripling production, and we can only do it for the next 12 years instead of the next 14 or 25 years. I also added in a $10 billion extra capital cost in 2032, because it's an oil sands project. The capital is not spread over 10 years. It's spent up front. If you want to triple production, you got to have more steam generators, more wells. You got to have more, I don't know oil sands processing equipment that well, but you need all the processing equipment up front. You got to spend the $10 billion up front, roughly. For 200,000 barrels addition, I'm guessing roughly $10 billion. If you work in SAGD, it's $7.554 billion, put that in there. I like to leave my spreadsheets open to interpretation, open to people who have better data, more accurate numbers. But yeah, just threw that in there as an example. This would be something that I would add to the spreadsheet later on. Once the main model is built, I can have all these extra things in there. And we end up with, again, different fair share prices. So on the 2P strip, again, our undiscounted value actually goes down a lot because it's undiscounted. But by bringing that production up, what we see is the 10% discount value goes from $48 a share to $54 a share. So whenever you discount something, if you can bring the cash flows closer, your fair share price will definitely get higher, because the number gets more and more, less discounted, if you will. So yeah, that's that on MEG. I'm gonna answer a couple questions here. So share buybacks will only increase the share value. Yep. Yeah, you're right, for sure. And definitely in the early years of the model, you're correct. Yep. The more shares they can buy back right away, the more the model will give them credit for it at the lower price, obviously. Okay, would you add the ESG cost for MEG associated with the SAGD wells compared to Montney? Not really. There's no way to properly put that in there. It's not a number. It's more subjective. So I can't really model that anyway right now, but I'm open to suggestions. If you know any way you want to put that in there, feel free to reach out. Share price is sensitive to what the market is paying attention to as the macro sets in. Yep. So Dirk, exactly why I think this is a great time to be looking at net asset values. People did not believe the macro outlook for the longest time. They thought shale was going to come back. They thought OPEC had millions of barrels of extra production sitting around. They thought demand was going to fall off a cliff. They thought there's going to be a global recession that just destroys oil again somehow. We're seeing that all these narratives have not really happened. And the macro reality sets in, exactly as you said. The bull cycle starts to gain wider acceptance. The reserves get more attention. ABC, simple as that. Okay, what about the operating cost increases due to higher gas prices? Yeah, for sure. This model, I love this way of modeling because you can put anything you want in there. If you think operating cost is going to be 2% higher, 10% higher, all you do is you take your cost number right here and you multiply it by 1.1 right there. Simple as that. And adjust things accordingly. Yeah, you know, it's not intuitive yet. It's a lot of Excel, like deep Excel, Google Sheets work, but I hope to make it intuitive and put in like, okay, what's your operating cost prediction? What's your development cost prediction? What's your inflation prediction, et cetera, and have the spreadsheet adjust accordingly. Okay, so great point. Royalties are per project. So as the new projects come online, the royalty goes down. And the way I've accounted for it, if we go to our royalties here, basically we were paying 21% royalty. As soon as I put the increased development cost in there for the production increase, I changed the royalty back to 18%. So there's a lot of things going on behind the scenes that I haven't really talked about, but yes, a lot of adjustments. If you spend capital, you get royalty credits. If you spend, it doesn't work like that way for taxation, but the more capital you spend up front, the lower your royalty rate becomes as you're in that pre-payout royalty regime. At $150 oil, it may not even really matter anyway, but again, something to be adjusted. If I set these WTI rates here to 125, you know, things change on the back end, but now I need to adjust for the royalty. The royalty is much different at 125 WTI versus 75 WTI. Again, one that will take getting used to, a lot of adjustments, and very early stage, very early stage. This thing is nowhere close to where I want to put it out for people to be using until it's more user-friendly, more explanations as to what's going on here. I see Bill on the chat here, so thanks, Bill, for this idea, and we'll have to compare models here whenever you have yours set up, and yeah, we can see where things are. So yeah, that's about it on MEG for the fair share calculations. You know, I don't think I would take 2p. I would take 1p strip, and I end up with a fair share price around $62 a share. Is kind of what I'm targeting. If I go back now to my free cash flow calculations, which I did for Q1, the exact same way that the previous 35, 40 companies have been done. If you're unfamiliar with the spreadsheet, please go to whitetundra.ca under archive seminars. You can see the exact how I end up with everything here. But if we scroll all the way to the bottom, $100 oil price environment, the fair share price ends up being $64.90 a share. Again, debt adjusted, adjusted for growth, adjusted for everything. So MEG is a very interesting company because not only does the free cash flow projection at 100 WTI gives us around $65 a share, the net asset value agrees with it. So for any new, you know, fund managers looking to get into energy, they want to look to get into the oil trade. If they come across MEG, not only does it make sense from a free cash flow perspective, if they don't want to look at cash flow, they can look at net asset value, and they end up at that same $62 to $65 a share. roughly a 3x from here. There's a reason it's my second biggest holding. Again, not investment advice, but it seems to check all the boxes. And I'll kind of leave it at that. So before I go on to Surge, are there any questions on MEG? I just want to talk about MEG's asset base here. So these are their leases. This is Christina Lake. This is Sermont right here. These are the undeveloped May River and other growth properties. If we zoom in right here to Christina Lake, we can see how we have our PDP reserve, and then we have our proved undeveloped reserve. It's so obvious when you look at it from a land holding perspective. We have our PDP right here, we have our proved undeveloped right here, and we have our 2P reserve right here. There's no wells in the area, so they can't claim any reserve associated with these. This is the Sermont project right here. The yellow is MEG Sermont, and the red is the ConocoPhillips Sermont, which actually is producing roughly 150,000 barrels, I want to say right now. So if MEG or if Conoco is already producing this and they have growth plans to double that, MEG Sermont reserves are pretty sure that there's oil there. What are they going to do with it? Are they going to grow it? Are they going to build it out? Are they going to sell it? No one knows. But the fact of the matter is, it gives us more confidence that there's actually oil here when there's a producer right next to them drilling wells and making oil. Okay, so any questions on MEG here? So, okay. What do you think about the risk of the windfall tax? So the Liberals and the NDP just voted down the windfall tax like I want to say 2 weeks ago or 3 weeks ago. Sorry, not the NDP. I think the Liberals voted down the windfall tax. So I'm not really concerned about it at this point, to be honest. I did reduce my margin exposure because if something like that came, it would be a big shock. This has happened before with the income trusts getting shut down and every stock just got whacked. And the last thing I need is to be in huge margin and to lose a significant portion of my portfolio on that. So I'm not really concerned about it, but it is something that I would rather not take chances with as well, because I was getting way too much into margin over the last month or so. Could you see this as a takeover company? Oh, for sure. Like MEG has always been a takeover target. The CFO is retiring as of September. Derek Evans, the CEO, was basically bought in to fend off the Husky takeover and kind of just steer it through. MEG has kind of proved themselves. They're paying off debt. They got the share buyback. I definitely would not be surprised to see them getting taken over as the macro kind of progresses and things become clearer. Yeah, I don't know if I want it to be taken over or what. Like what I want, I guess, is not really that important as to what the market does. But I think a lot of shareholders, if you can get $30 a share today, probably take it. You probably take it. Not investment advice. I'm saying a lot of people will probably end up taking that if they had an offer at $30 a share right now. The Husky offer at $11 was a complete joke. Different macro environment, obviously, but yeah, I think at this point, it all depends on your personal preference. I think a lot of people would just take the money and redeploy it into something else. Because, yeah, go ahead, yeah.
We just start making choppy.
Okay, okay, I'll just try and fix it up here. Okay, yeah, let me know if it cuts out again. Okay, so that's MEG. I'm gonna run through Surge really quick and then kind of end it here. I don't want to keep people waiting too long. So basically, I did the exact same thing for Surge. If you go to Surge's annual information report, we have the exact same information. So we have our PDP, we have our undeveloped, we have our 1P, and then we have our 2P, undiscounted, 5%, 10%. Surge does not give me the PDP valuation on the full calculation. It only gives me 1P and 2P. So a little bit harder to get this model correct, but working on it, doing my adjustments, whatever I can. And basically, we run the exact same numbers. If somebody was looking at Surge on PDP at forecast, they're looking at a fair share price of $5 a share, 447. Doesn't make any sense. But that's what the number is. If we go to their numbers here, the PDP value is 620 million, 5% is 673, and 10% is 623. If we go back to the spreadsheet, 621, 649, 623, very close. We're very, very close to numbers that they give us. The reason the undiscounted is lower than the 5% and even the 10% actually is because decommissioning liabilities are looked at differently with conventional producers. With the non-oil sands producers, the decommissioning liability gets put in further down the road as kind of like a block, as opposed to spread out over many years. Like it is with an oil sands play, the decommissioning liabilities are also much higher. With MEG Energy, the decommissioning liabilities was roughly 5% of PDP. With conventional plays, it's 10, 15, 20% possibly in some cases. I don't have the number, so I can't really tell you. But I'm going to look to get the PDP number for this table here, so I have better comparisons to make as I go along. Okay, so so we have this here. The thing with Surge is that when we adjust the numbers for strip value, the numbers change significantly. So they go to $11 plus a share, $11 at 5% discounting, because it's a conventional play. So the discounting affects a lot more, and the adjustment to strip price changes a lot of things as well, especially on a high debt, high ARO producer like Surge. So we're trading right at PDP strip right now, about $11, $12 a share. If we go to 1P strip, again, I would pick a number between the 5 and 10% discounting. So $22 a share undiscounted, 18 at 5%, and 15, 16 at 10%. So it gives me roughly a fair share price of $16, $17 a share. Now, I want to make one point on Surge. I did not put the gas revenue in there. This is only the oil, which is roughly 85% of Surge's production. When I did a rough back of the napkin calculation to add the gas in there, the natural gas and the NGLs, it added roughly $5 a share of reserve value. I did not have enough time to get the spreadsheet fully accounting the gas, the natural gas revenue, so I didn't put it in there for now. But I just want to say, once we add the gas reserves in there, we go back here, we have light oil, heavy oil, and we have the gas reserves. So all this reserve so far, I haven't put in. Again, as the spreadsheet progresses, these things will be put in. So yeah, so I'm looking at roughly $16 here for 1P strip. I add in the $5 for the gas and the natural gas liquids, roughly $21 a share of value. If we go to Surge's corporate presentation, total proved at $85, roughly $18 a share. If we take this chart here, this table here, and we extrapolate it to $100 WTI, we end up at that roughly $21 a share once we add the $5 for gas. Again, I'm talking a little bit complicated here, bouncing all over the place. So I'll make the example again with the 2P strip. So when we go to 2P strip pricing, the fair share price at undiscounted is roughly $28 a share. 5% discounting, $23 a share, 10% discounting, 18.5. I'm going to pick the number between 10 and 5% discounting, roughly $21 a share. I'm going to add the $5 for the natural gas and natural gas liquids. I end up at $26, $27 a share. Go back, compare what the company tells us. It tells us the model is a little bit busted here. They're getting $27 for 2P at $85 WTI. We're getting $27 at $100 WTI, which tells me the model on the 2P has gotten a little bit out of whack. And I'm going to kind of adjust that as I go along. The reasoning for that, I don't really know right now. It's somewhere baked in here. But if you look at the way I've done this, the cost change, the royalties are changing as we go along. The oil produced is adjusted, and the oil prices are adjusted. So there's a lot of adjustments made, and I've tried to explain them as best as I can. And by the time the full spreadsheet comes out, it'll have a full explanation of what's going on, what boxes to put in, what things can you adjust, what do you want to adjust, et cetera, et cetera. So that's that on Surge. I want to share a little bit on Surge here. These are all of Surge's properties that they have. If we look at Southeast Saskatchewan, again, we see the same thing. We see our PDP right here. We see our probably our proved undeveloped right here. And then we have our 2P reserves, the probable that they are getting no valuation for at this point. Southeast Saskatchewan, we can zoom into the Sparky and see the same thing. Here is our PDP. This is probably our proved undeveloped. And then we have our 2P reserve where they own the land, but there's nothing that they can use to say that there's oil there. Yeah, so I like sharing the visual because it makes the reserves more obvious, the different types of reserves categories. And that's that. That's literally what I wanted to share today so far. Oh yeah, if I go back to the free cash flow calculations on Surge, the ones that were done after Q1, accounting for hedging, accounting for growth, we, let's say $100 WTI, we end up at a roughly $23 share price, which is very close again to their net asset value. It was roughly at $100 WTI strip pricing. 1P, 2P reserve. 1P reserve was roughly $22, $24 a share. So very close. Why I chat about Surge is because we're almost in Q3 already. If we take out the Q2 hedges, that number goes from 23 to 27. If we take out the rest of the 2022 hedges, it goes to 31. And exceptional torque to higher pricing. Every $10 move in WTI is worth roughly $7 a share in share pricing. So again, full disclosure, Surge is my biggest position. And just want to share a little bit of the reasoning. I'm looking forward as the hedges drop off. I'm looking into a higher macro oil price environment, which is going to change the reserve values as things go along as well. Surge is also developing a lot of their Southeast Saskatchewan. They're developing their Sparky with the multi-leg horizontals. And that will just continue to add more and more reserve going along. And we compare that with the free cash flow calculations. You take them both, put them together, and those are the sorts of valuations I like to see. Okay, so yeah, that's that. If there's any questions, I can answer them here. If not, we'll end it. Once again, the space is recorded. The video is recorded as well. So I'll have that posted here in probably later this afternoon here. And we'll go from there. So a couple of questions here. Does that include Surge recent acquisitions? Yeah, so it includes everything as of December 31st, 2021. So both the Astra and Far Sky deal had closed by then, so they're both included. The new drilling methods I don't think are included yet, especially the multi-leg horizontals. So I will watch for those revisions going forward. Whether they make a material difference, I don't know. Where I think they're going to make a difference is in these sorts. Where I think it's going to make a difference is
running into
is it getting really bad, Sohaib, or
just the we're good. Yeah, we're just getting
okay. Okay, I think this happened last time too, where the Twitter just completely messed up. So I might just end the Twitter and then continue on with the.
You what we can. Yeah, it's super bad.
Okay. Okay, I'll just end the Twitter and kind of continue on the Zoom for now, unfortunately. Can people on the Zoom still hear me? Can you put on the chat if you can still hear me? Yeah, okay. Okay, right on. Okay, well, I'll just go through some questions and then I'll end it here. But so, yeah, so the new reserves, basically, what I think is going to be more and more affected in like the undeveloped areas and the non-reserve areas. If Surge is looking at the Sparky, they're saying, look, these wells are way more productive than these wells or these wells right here. But if the multi-leg horizontals work out on the fringe areas, you see where they're doing the multi-legs, it's like kind of in the fringe of their acreage. Well, look at where they have the undeveloped stuff. It's basically on the edges a lot. This package here, you know, this package here. If they can drill 1 or 2 or 3 good wells here, multi-leg horizontals, and show that this is productive acreage, they can get reserves for this entire block here. And that's when the reserve numbers actually go up a lot. So I'll be looking very closely to see if they spot any wells in like these wide open blocks that they have. Yeah, great question. Please click OBE for a second. Sure, I'll. There you go. There's Obsidian, Ray. Prairie Provident claims $1.04 per share NAV at 90 WTI. Would you agree? Yeah, Prairie Provident, I do agree, because Prairie Provident, I've looked into the reserves, I've looked into their acreage, and keep in mind, almost 85 to 90% of Prairie Provident's value right now is in debt. So when you take the debt out of the equation and you add only, you know, a couple $100 million of reserves as WTI goes up, it has an extreme impact on the per share net asset value. Because the company is so highly leveraged, not only do they get that benefit on the free cash flow projections, they also get that benefit on the net asset value projections. Because remember, again, at the end of it, we always subtract debt. And if the debt number is really, really high compared to the total value of the company, each increase in this Q3 number right here has a leveraged change on the fair share price. Okay, could Surge be a takeover candidate? Possibly. I don't think Paul is going to sell for anything less than $25, $30 a share. So if somebody can convince him, possibly, but I don't really think so. Surge assets are just set up right here to really do well, in my opinion, as they build out the Southeast Saskatchewan, as they build out the Sparky. There's a lot of potential that would be lost in a sale right now, and I don't think I would be pushing for a sale or anything like that at this point. What do you think the odds are that some 2P reserves would be added in a buyout of MEG, considering the potential scale? That'll depend on shareholders, honestly. I think the way that I'm looking at MEG, I would love to get $40, $50, $60 a share by just holding on to it for a year or 2 or 3. I just don't think it's going to happen. There's too many people interested. The supply issues are just too much worldwide. The macro is just looking more and more and more bullish. Demand has not really dropped off, even at these pricings. So I definitely think that I will have to let go of MEG for a lot less than what I wanted in the next 6 months, 12 months ish. And yeah, we'll kind of see how it plays out. But what I really want is a bidding war, honestly, for MEG. If some of the international companies start to want to come back in, maybe they start competing with the, CNRL is not going to overbid for anything, but some of the other oil sand players in the area, yeah, as a shareholder, that would be best case scenario for me. Right on. Okay, so in the beginning, you mentioned something about analysts readjusting your share price. Yeah, so basically what I think happened is analysts were running the free cash flow models and the net asset value models and coming up with crazy numbers, as were all of us. And then TD and I think another bank put out these reports talking about the royalty rate changing, which a lot of people are not really aware of, the pre-payout to the post-payout royalty. And that put a damper and kind of held the price in that $17 to $20 range for a long time. So I think they adjusted their models and they came up with something a little bit different. However, I think the royalty rate change is not as drastic as it seems either. So management is saying it's going to go from 10 to 15% to 20 to 25%. I would think it's probably in the 25 to 30% possibly if they don't do any capital spending next year. But I don't think using 40% is correct either, because I don't think that's where they end up, given the other ways to get credits and save money, along with the fact that post-payout royalty is after operating cost and other costs, whereas pre-payout royalty is on gross revenue. So there's an adjustment there that has to be made. I don't know how closely the banks have done that. I'm sure they've got a pretty good handle on it, but I don't know the specifics, sorry. So Patrick's asking, so the fair share price of 23 to 39 to 31 to 44 at WTI 100 is with the hedging removed. Patrick, are you talking about Surge or MEG? Can you please clarify, and I can open up the chart, the right spreadsheet and show you. How often do share prices finally reach the net asset values? It depends. I don't think we're going to reach 2p strip net asset values. I don't think so. However, can we reach 1p strip net asset values? For sure, definitely. Especially if you're not giving any credit to the undeveloped acreage, the unknown acreages. I think we can get to 1p NAV for sure, for sure. 2p would be a stretch, definitely a stretch. What do you think about Vermilion reserves? Seems like they've added a lot, but some people are hesitant. Yeah, it's just fake news, honestly. The whole Vermilion doesn't have inventory thing just caught on fire, and everybody started saying the same thing without looking at what's really happening. When Vermilion made the Spartan acquisition, they actually added a lot of reserve. Is it tier 1 reserve? No, but they added a lot of reserves, and they're pretty much in their peer group at this point. Yeah, I don't see them as being wildly having issues with reserves. And Vermilion has way more reserves in, not reserves, Vermilion has way more potential to add reserves in Europe with European natural gas than people are accounting for. And that's where the moneymaker is. So to me, it's actually a positive and where the opportunity lies. Because nobody, I can guarantee you, people still are not paying attention to Vermilion and what they're doing in Germany, what they're doing in Croatia, what they're doing in Ireland. Some of the stuff they're doing in the Powder River Basin, some deals they've made, people are not paying attention. The Leucrotta deal looks absolutely phenomenal now with AECO gas price at $8, WTI at 120. Yeah, it's going to be very hard to make deals like that now. given that there's just not that much Montney out there available to purchase in those sorts of blocks. Okay. Among the oil companies you follow, is MEG looking the best from an upside perspective? I wouldn't say it's looking the best, but it's one that gives me very little downside and gives me the upside. It gives me the funds flow coming in. It gives me the buyout potential. It gives me a 60-year reserves, and it gives me funds flow. Whether people look at cash flow or whether people look at net asset value, I get the benefit of both. So it's all going to depend on your portfolio construction. No name is better or worse or has the most upside. It's all going to depend how your portfolio is structured as well. I could buy a whole bunch of junior companies and have that be 100% of my portfolio, and that would give me the most upside, but not really the best portfolio construction by any means. So, but yeah, definitely a big fan of MEG. Not investment advice, but I do like MEG and the way the company's set up. It's kind of one of a kind. There's no one else like that, which is great. Did you sell all your ARC resources? Yeah, I did sell them. Was it this week? Yeah, earlier this week. I think Tuesday or Wednesday, I sold the entire position. The free cash flow just isn't there anymore. I was modeling roughly as 15-16% free cash flow yield. When I can buy 25-27% free cash flow yields at strip today. So it just got to a point where I saw better opportunity out there, and I just wanted to reduce my margin a bit. I still have my ARC options that are very highly leveraged, very highly torqued. So I still wish them all the best. It's just not a name that I want to hold going forward. And it's really too bad, because I was a pretty big proponent of it last year, November, December into January, and it just has not performed. And I can't just blame the share price, because the company itself has not performed, and that's reflected in the share price. Yeah. I think you mentioned in another session. Yeah, so Surge and Spartan Delta both have hedges coming off June 30th. Spartan Delta's oil becomes completely unhedged, whereas Surge loses kind of their worst hedging. They have less volumes hedged, and they have the volumes hedged at a much better price. So Surge, the way I calculated for Surge was, and again, throwing numbers out there, is from what I know, is that if you look at 2022 Surge at 100 WTI, they were going to free cash flow 231 million. If we look at June 30th or July 1st onwards for 12 months, because the hedges drop off, the free cash flow at 100 WTI with nothing changed goes to $310 million. So the free cash flow changes about 30% more, 35% just from the hedges dropping off. If I look at the exact same company with no production increase, nothing, with just the 2022 hedges rolling off, the 2023 free cash flow at 100 WTI becomes 370 million. So that's the impact that the hedges are having on a company like this. The increased AECO pricing added another 10 or 15 million, I believe. So, just all those things, I took them into account, and I said, okay, if I run a free cash flow times 6 on 231 million, then I run a free cash flow times 6 on 310 million. That's enough reason for me to hold on, along with the various other things I've mentioned about this company. Is PetroTal penciled in for coverage? Not really, no. I think I covered everything I really wanted to say about PetroTal in the valuation session. There's not much more I can add. I don't know Peru. I don't know the people. I don't know the acreage. I don't know the social issues. I don't have any insight to add. So unfortunately, nothing really I want to share there, but I will be updating the price targets now that their Q1 report is out, I believe. So I think that's one of the companies where I haven't updated it yet. So I will do that, yeah. Okay. See that you reduced the white cap calls. No, I didn't really reduce the white cap calls. I had to sell the June calls because it was getting close and I didn't want to hold them to expiry. I didn't make very much money on it, like 20%, 20 or 40%, I believe. The other white cap calls are up over 100%. So keep on keeping on for sure. I'm not really disappointed with anyone. It's just lagged. And like I've said before, I love buying companies that have lagged for 3 months. Meanwhile, the macro has gotten stronger. They've paid off debt, and I'll just sit on them. You know, Tamarack Valley, perfect. That was a really great entry point. And I don't want to pat myself on the back, but buying companies that have lagged for 3 months, that are doing really good stuff, they've done acquisitions possibly, has been a win-win-win scenario for me. So why would I switch out of that? And Whitecap is in the exact same boat. It's been at that $10 to $12, $9 to $12 a share for a long time, and I'll sit on it because that's where the money is going to flow in. The ESG money is going to flow into it, and when it starts flowing, it's going to flow. Obsidian is up 55-60% in 2 or 3 weeks. Let's say a month. Can Whitecap do the same? Much bigger company, but when the money flows in, it doesn't stop. It just pushes it higher and higher and higher. Do you think it is safe to use 100 WTI as a base target price? I can't answer that question for you. You have to use whatever you're comfortable with. I'm using 110. I think I'm up to using 110 at this point because the strip is almost there, and I see more and more supply issues popping up. I see no huge changes in demand and inventory. Like, I think the inventories are just so low at this point that even if demand dropped and we got into a tighter undersupply situation, the inventories have just fallen way too much at this point that WTI cannot drop to 80, 75. It's just not going to happen unless there's a massive virus or there's a huge, some sort of massive global depression. The inventories are just too low at this point. Just my opinion on that, and I can elaborate further, but I'll maybe leave it for now. I'll leave my thoughts for a space here. Westcan, I have no update on Westcan. I am not really kept in touch with management with my travels over the last 2 weeks. And the interesting thing about Westcan is they haven't even pulled a drilling permit yet. So it's mid-June now. They have their AGM in 4 days. So I'm just going to let people update me based on people who are going to the AGM June 15th in Calgary. Let me know kind of what's going on, the latest. Yeah, I don't have any update. I don't know why the shares are moving. My shares are locked till August 1st anyway, so it's pointless for me to keep tracking it day after day after day. I literally cannot sell them till August 1st. Not to say that I would or wouldn't, but I don't even have the option. So why waste time on it? Watching the day-to-day market movement. Do you plan to add the spreadsheet? Yeah. Once I'm on the 3rd or 4th iteration, once I've made it a little more user-friendly, it will be added. Yeah, the free cash flow yield spreadsheet is still on there. I'm going to try and convert everything to Google Sheets. I'm working on it because Google Sheets lets me automate the WTI price. It lets me automate the exchange rates. It lets me automate the ACO price. I can pick up the number of shares outstanding, the active share price. It's all automated, which Excel doesn't let me do. So still working on moving everything to Google Sheets. Give me about a couple of weeks or so, and everything will be on Google at that point. Yeah, so I did add a couple of junior names. I looked at over 50 of them, probably 75 junior names I looked at, and private names. More than 75% of them are complete junk. It's all garbage being marketed with some sort of story. But I did find 7 to 10 that I really wanted to take a position in. And out of those, 3 or 4 are totally illiquid. So there's no point for me to get into them, and I wouldn't be able to get into them anyway. But I did find 3 or 4 or 5 with good blocks, and I was able to buy them. I bought them above market price because I just wanted a bigger block. And yeah, I don't want to talk about them too much because I want to do the due diligence sessions on them specifically and share my thesis. But Prospera Energy is basically a play, high original oil in place, older wells that have been shut in for a long time. If you know why I like Razor, this is a Razor-like play, and it doesn't even need a CO2 pipeline. So they just have high original oil in place fields that have only been targeted with vertical drilling. If we put horizontal drilling into them, it changes the entire field, and you already have the oil in place. Again, this is not investment advice, and I want to do a much deeper due diligence session. But right now, yeah, it's gonna take me an hour if I start talking about these things. Same with 10th Ave. It's a about 150 barrel a day producer, growing bigger. They got I believe it's a CO2 or water flood that's active right now. That one's actually like a mini Hemisphere. When Hemisphere did the polymer flood, they're growing bigger and bigger. This company is like 1/10 the size of Hemisphere, no pun intended, and doing their polymer flood thing, I believe. They've got a small portion in Swan Hills, the field that CNRL and Razor has, Razor Energy. So upside there, possibly a few BOEs a day as those fields get capitalized. On an overall though, I am looking at more junior companies, more private placements, more on the smaller side. I don't want to overexpose my portfolio to them, but I definitely think the opportunities for the 3, 5, 7 baggers are maybe no longer in the bigger names. They're now in some of these names. Please, please, please don't just go and buy these randomly. They are very thinly traded. They have a specific thesis to them. They've jumped a lot actually in the last couple of weeks. Please do your own due diligence. Please, your risk tolerance. People lost a lot of money in 2010 to 14 on these junior companies and investing randomly in everything that came up. There's a lot of people that are pushing me to buy random companies, messaging me, emailing me, calling me, and you just got to ignore them because some of the companies that they're talking about are just not worth anything to begin with. I'm getting lots of questions, so I want to end it here, kind of on the hour, maybe. I'll give it another 10 minutes. Thoughts on Athabasca? I'm not buying Athabasca. There's no way. The amount of money they lose, on random things, the warrants, the hedging, the royalty, is just too much downside. Are they still going to make lots of money? Yeah. Oh yeah. Are they still going to do really well? Probably. It's a very high torque play, as you mentioned. It's just not my style. I have a running blacklist of companies, and nothing is going to make me buy into Athabasca at this point, unfortunately. But I wish all the best to all the holders. Yeah, I am going to update Razor's price sheet. Yeah. I have no comment on Razor. I'm going to leave it for 2 to 3 years, and I'm going to let them do their thing. There's no point nitpicking. When is the geothermal coming online? When is the CO2 getting built? What is the oil price doing? Because it really doesn't matter, to be honest. My thesis on Razor is more of a 2 to 3 year cycle of $100 plus oil and the money that it gives them to capitalize their assets. So for me to look at day to day, again, there's no real point. Yeah, I will be doing net asset values on natural gas as well. Yeah, like you're gonna have to bear with me because this took way longer than I thought it would. The setting up the spreadsheet to begin with, and I had to hard code a lot of stuff. I had to make a lot of adjustments, figure out a lot of stuff on how royalties work, on how the development costs work, etc. So I'm kind of like nerding out on this right now, while taking care of the market as well and managing my portfolios. So yes, I will have that going forward. Yes. Okay. If we're going into recession, what do you expect oil prices to drop to? So I kind of answered this. I think the word recession is just being, people are just throwing it around, and no one has any idea what it means or what they're trying to say. So you know what, if anyone has a thesis on this exact question, that if we go into recession, what do you expect oil prices to drop to, please message me. I would love to have a discussion on this, because most people who are throwing out the term recession, I try and start a conversation with them, and they have no idea what recession even means. They're talking about a minus 0.1 or minus 0.3 GDP quarter over quarter. Is that a recession? Depending on what metrics you're using, depending on what definitions you're using, it could mean one thing or another. Have we had recessions in the past with no drop in petroleum demand? Absolutely. I just posted about that about a month ago on my Twitter feed. So yeah, I'm honestly not worried about global demand this summer. And as we kind of go on, I will adjust my thesis. But so far, nothing to me tells me we're in any sort of issue, major issue. Just because you went to the gas station and five of the pumps were at even numbers, you can't forecast 100 million barrels a day of worldwide oil demand off that. Absolutely wrong way, in my opinion. And not trying to target anyone. I'm not trying to say anyone's data is bad or wrong or incorrect. I'm just saying I would rather have a more nuanced, deeper discussion than just saying recession or demand destruction and using that as your argument. Have you heard talk of any hedges coming on? I don't really know what you mean by that, but I'm not really seeing any producers hedging going forward, other than the ones we know, the Crescent Points and the Arc Resources and whatnot, that always run that way. The more aggressive producers are actually not putting any hedges on, and pretty interesting to watch that, because they have good insight into what's going on, especially the US shale producers. They would know a little bit as to the supply response and whether they should be hedging or not. And what are they doing? They're not hedging. Should give you a pretty good idea as to what to expect out of US shale and worldwide oil pricing going forward. You mentioned about institutional buying coming back. Yeah, it's just overall fund flows that I'm seeing. I don't have anything specific to give you, but when you see companies go green day after day after day after day, like Obsidian did, like Surge did, like MEG did, like Crescent Point did, in like these sorts of names, even with the oil price not really doing much, that to me tells me that money is piling in. I'm seeing a lot of people talk about oil stocks. I'm seeing a lot more people message me, people who would never have been in oil before. So yeah, just anecdotal stuff. Does it really mean anything? No, but the share prices reflect that exact thing happening. So I'll put it 50-50 that it is happening. How far out do you sell your options? At least, I try to sell them at least a week before. And if you're worried about volume, I really wouldn't be, because what I found is the robots end up buying everything. If you just put your sell order between the bid and the ask, and then just keep adjusting it 1 cent down at a time, the algos and the robots end up buying it, because they want to make that 1 cent or half cent. I've never been stuck in a call where I had to sell it below what the bid price was by any means. I got these 5 Tamarack Valley calls I ended up accidentally buying, and I was even able to sell those, even though it was just 5 calls. And I sold them above the bid price. Yeah. Could you comment on gear? I can't really comment much. No, great management, great assets. They've done some multi-leg work, multi-leg horizontals in Lloydminster that did not pan out. Their single well fracked wells were actually better from a production standpoint and from a reserve standpoint and EUR standpoint. So far, very early yet, but so far I'm kind of seeing it that way. It's just overvalued in my opinion. I'm not interested in buying companies at 12-14% free cash flow yields. I don't see the upside there in this sort of environment. Yeah, but great company. They got the dividend, I think, out now. So yeah. Yeah, thank you, Beth. Always appreciate you joining. I know we got some chats on Twitter, so yeah, thank you. Eric just added lou.v. I don't even know what that is. So oh yeah, Lucero. I believe he already had that. If that's the company I'm thinking of, the Lucero Energy, that's the same as Petroshale. It just got rebranded into that. And if I'm wrong on this, please call me out. But that's my understanding. And yeah, generally speaking, I do think the low-hanging fruit is gone. Yeah, in the bigger E&Ps, for people that know me, I'm looking to hit home runs. I'm not looking for a 10, 15, 20% increase in share prices. So, I mean, there's names I'm watching. I got into Obsidian, which is a bigger name, Tamarack Valley. I still like Spartan Delta. I still like Crew Energy, if I can find a way to get into that. But yeah, I am looking at some of the venture names for sure. Like I said, my last month, 6 weeks to a month to 6 weeks have been spent on deep diving into these small companies below $100 million. And it just takes forever because they don't have corporate presentations. Their Q1 reports are basically have nothing in them to go off of. And you're doing a lot of guesswork, try to meet with management. I've actually, a couple of the companies, I've contacted people who were production engineers like 3 years ago at these companies. So they would have some sort of insight into what the upside is in $100 oil price environment. And yeah, I'm having to go really deep now into weird places to find information on some of these names. And the other thing with these junior companies is some of them will flat out lie to your face. It's the exact same as US shale. And the reason I don't buy shale companies is because they will tell you something about their field, which it's very hard to verify, and they will just go with it. And you gotta call them out on it. Yeah. Any thoughts on KEI? I think that's Kiwatnock. I'm not wrong. No, I don't buy companies that are pushing the ESG thing and trying to pretend like the market's going to care about it. They're not. They're not going to care. Look at any company, any E&P that tried to do a wind farm and a solar thing. They basically got no credit for it and they got laughed at. It's run by Pat Carlson, who I have a lot of respect for. So maybe he can make it work, but not something I'm quite interested in at this point. Any concerns on Razor ARO? I'm probably going to get shot for saying this, but I don't care about ARO at all. I don't think asset retirement obligations matter, to be honest with you. People are taking ARO and sticking it into year one as if it's a net debt. The banks are treating it that way. The regulator is treating it that way. It's not the right way to think about it. Like when you buy a car, do you just add up all the oil changes and all the brakes and all the tires and just like say, oh, I should like save up this money today? No, that's not how you deal with these things. As you go along, you do your asset retirements. Simple as that. At $100 oil, there's way less wells to retire than there was at $60 oil. Because at $100 oil, a lot more wells are economic. It may make sense to spend $150,000 switching out the entire tubing string and the casing and doing a refrac and all this. It may make sense at $100 oil. You might get a 2-month payout. At $60 oil, it was an 18-month payout. So you'd rather just abandon the well. But things have changed. I think ARO is the most misunderstood metric in oil and gas. I see ARO as opportunity. Companies with high ARO have a lot of suspended wells for free that are already drilled, they're already completed. They just need a little bit of workover and they can be back on production. Why would I not buy companies like that versus companies that have to spend $5, $7, $10 million drilling new wells? Just my opinion, just my 2 cents, not investment advice. And it will depend on what you think about the macro going forward. If you think oil price falls $30, ARO becomes more and more of a concern. At $120 oil, I would bet there's very few wells out there that are worth abandoning as opposed to fixing up. and getting them on production. Yeah, I'm going to do a due diligence seminar, yes, on all the additions to my portfolio. We have Obsidian Energy coming up next week, next Saturday, on a valuation session. And then I'm going to do a due diligence session, kind of 2 companies a week, kind of as I go on some of the smaller names and sharing what I see there. And in fact, what I wanted to do was one company that I invested in, and then one company that I did not buy, and I'll share why. I'll share what was wrong with it, which I think is a better way of doing things than to just be bullish, just sharing all my bullish names. I'll share stuff I'm seeing in junior companies and why I don't buy them, which I think is just as important to know as opposed to why I am buying them. Yeah, thank you. I'm not concerned. I'm a bit concerned about the WTI WCS spread widening, but it has nothing to do with the takeaway or the quality. It has to do with the SPR releasing heavier oils. If you look at Shell's Mars platform in the Gulf of Mexico, which is a heavier oil, it's trading at $6 below WTI and used to trade at par. So if Shell's Mars oil is trading $6 below WTI, that's exactly the change we've had in the spread in WCS. It went from $14 to $20. Not a big deal. The SPR is going to end. The other thing with the SPR is they've drawn down so much heavy oil that I don't know how much is really left. How much heavy oil in the SPR is left that's actually usable, that's not saturated with water, that doesn't have metals or corrosion or H2S? I would bet not as much as people think. The SPR has never been drawn to this level in the last 40 years. We're going to see some issues pop up here that the market may or may not have priced in. Rock Creek Freak on Twitter has talked about the caverns and whatnot a lot, so I'm kind of piggybacking off his information. But I looked into it a bit too, and what I figure is I don't think the SPR can go below 250, 300 million barrels to begin with. The rest is all junk oil in there that's been sitting for 40 to 60 years. Yeah, maybe even longer. I don't know. Yeah, so we're gonna see a lot of factors here come up that move away from strict supply demand and strict fundamentals. We're going to see engineering, geology, these sorts of things make a bigger impact. The perceived shortage, the geopolitical risk, make a bigger impact as we go along. Okay, well, I kind of want to end it here, so I'm just going to finish up with the questions, and then yeah, we'll let people enjoy the weekend. You have an opinion on Saturn? Not really, no. I looked into it very deeply, very, very deeply. I ended up buying the warrants like 3 months ago, and then I sold them. Would I possibly buy the warrants if they continue to lag? If I can get a big block at 3 cents? Yeah, I think I would consider it. The June 2023 warrants, I think the risk reward on them is heavily skewed in my favor, especially as some of the hedges drop off end of this year. And the new acquisition, I believe, is fully unhedged. Maybe there's hedges on it, but at higher pricing. So watching closely, but why should I buy Saturn when I can buy ROK Resources? It's the exact same company, like pretty much literally, and I'm hedged at $30 a barrel higher than I am on Saturn. And you'll see, again, full disclosure, I did buy ROK, I believe it was last week or the week before. Because I saw Saturn, I saw what they were doing, and I just had a better thesis on ROK. Arnold, yeah, thank you. I will definitely check out this global macro, and I think for sure, recession, the economy, the stock market, and oil demand, 4 completely different things. Recessions are not directly linked to oil demand. The economy is not directly linked to the stock market. We have to stop confusing these things and assuming they are, or making some sort of thesis based on these 2 or 4 things being linked. Do they have some correlation? Yes, but not as direct as people make it seem by any means. In fact, I've seen so many manipulated charts over the last month talking about recession, just fake, like fake nonsense, talking about year over year comparisons that this happened and that happened. And then you go back and look at it and like it doesn't even make sense what they're trying to say, because we're still 20% above pre-COVID demand or 30% above pre-COVID demand. How can that be a recessionary? Uh, like that's where your definition of recession will be very important, because you can compare everything to 2021, the highly monetized time, and claim we're in a recession. But does it really mean anything? Maybe not. Yeah, something to really keep in mind. People are really pushing out the recession narrative with inaccurate, wrong charting. Yeah, I saw one the other day. It was hilarious. It was like the rate at which the backlogs were accumulating has gotten lower, and that means there's a recession occurring. Like what? Not only has the backlogs not started to go down, they're actually accumulating more, but at a lower rate than it was in 2021. And you're using that as a recession indicator. Like, come on. Okay. Yeah, and sorry, I got a little bit heated on this, but I've been so many messages about recession and demand destruction and all this that are backed up by absolutely nothing. Yeah, and okay, so your view on Cardinal Energy. I think Cardinal is probably getting better and better. They shot their bullet, if you will, with the big dividend announcement. They went up huge, and I think if anybody wanted to short any stock, I think Cardinal, after their huge run up on the dividend announcement, would probably have been just about the only candidate. And at this point, I think now it's back within its peer group, with Surge jumping up, with Baytex jumping up, with Tamarack jumping up. Now it's basically back within its peer group. I don't like Cardinal because of the scattered assets, the number of VPs always just gets me. It's kind of like almost on my blacklist in a way. But unhedged, one of the biggest tax pools along with Surge out there, and Obsidian, and pretty high free cash flow yields. So yeah, for those who like that, definitely a great pick. KEI is Colibri. Not aware. I've stopped doing research on anything that's non-Canadian asset. I did a lot of work on these junior companies. I looked at Nigeria, I looked at Colombia, I looked at some other players in Peru, I looked at the Egypt ones, I looked at some in Thailand and Indonesia. And what I realized was I have no edge. I have no edge in those areas. I don't know the assets. I looked at some in New Zealand. I have no edge, and I don't like that. If I can have a better understanding of the Canadian assets, why should I move into things that I know less about? And I think, I don't know where Colibri is, but I want to say it's non-Canadian asset. Yeah, CPG is definitely moving. Yeah. So I'll kind of end it there. Thanks again, everyone, for joining. Appreciate it. Always love the questions, the back and forth. Well, it's not really back and forth, but it's just the way these things are set up. Just me rambling on and on. But I do want to put these net asset value calculations more into the overall understanding of the companies and the portfolio construction, building out quite a few things. We have Surge Energy on this week, I believe. Not Monday, Tuesday, or Wednesday. I think I have them lined up for. There's a couple other names also coming up. I'm still working on Enerplus and i3, and working on some other things behind the scenes too. I still want to get the intelligence dashboard built, which is basically going to show charts of all the company's production and all the company's 2P reserves and all the company's growth plans in like one easy page. Has been a lot harder. Everything has been a lot harder than I thought. I'm going back into coding and HTML and all this, which back to the high school days, and I really don't enjoy software stuff too much. Excel and all that is fine, but yeah, but anyways, I do want to put out a lot of content here over the summer, especially as a bull market kind of goes on. I don't have any plans for any macro outlook yet. I think the April 30th one is still accurate for the most part. Nothing really has changed too much. But yeah, definitely do these, talk about the smaller companies, the junior companies, and some of the other stuff. And yeah, we'll just keep on keeping on. And I know everyone with a energy portfolio has had an awesome month. Where tomorrow would be the 1 month anniversary of May 12th, which was the day of doom, if you will. And since then, it's just been fantastic. So I think it's been a thesis we've been going with for the last 12 months is every time there's a drop off, it just continues and goes back higher and higher and higher. So I think people love taking victory laps, but I like making money. So for me, that's really all I care about. It's not about being right. It's not about doing this or doing that. It's about making money, and that's what I try to do. So yeah, once again, thanks for joining. Happy Saturday, and the recording will be posted here in the next couple of hours, and we'll see you next week. Cheers.